Pro Mujer is a 20-year-old organization. We operate in 5 Latin American countries, Bolivia, Peru, Nicaragua, Argentina, and Mexico. We have about 250,000 clients. We have a loan portfolio of about $100 million at the end of 2011 and about 1,600 employees. Our organization started with our 2 founders in Bolivia, originally as not a microfinance institution, and we still call ourselves a women's empowerment and development organization. That's really what we see as our mission, and we see microfinance as a tool to that. We share a lot of characteristics with others here who have presented their ideas and organizations. So our founders started with training and self-esteem classes for women, and then moved into microfinance when their own clients said to them, what we really need are ways to improve our income. Our loans are through a village banking method, which is a very classic microfinance method. Self-governing groups of women of between 10 and 20. We loan them the money. Our average loan today is about $400 per client. It's different in each country. And we loan only for productive activities. It's hard to always discipline that, but that is our aim, to loan women money that they can use to create streams of income that improve the lives of their families now and in the future. And in the groups that are self-governing, they themselves handle a lot of the money. We view it as extremely important that the group is self-governing with a sort of governance structure of their own, a president, a treasurer, and so forth. And it's also very important that they guarantee each other's obligations. Very classic neobank. From the very beginning, we've always felt that the credit itself was not sufficient to help people break the cycle of poverty. So we have always offered other development services. We run a fairly large healthcare organization within our system, where we have clinics in almost all of the branches that we operate in. In those clinics, we employ our own doctors and nurses and provide primary and preventive care to the women and their children. We also do training, very basic training in self-esteem, in women's rights, in basic literacy, in child nutrition, and in a lot of health topics that are important to everyday life: sanitation, child nutrition, birth control, things like that, family planning. So it's a very integrated model, and it's one in which we directly provide those services. One country we outsource the help, that's Argentina. We also oblige our clients to save at the same time that they take out a loan from us. So with every payment that they make on their loan, they make a 10% of their loan in regular contributions to their own savings account. We are not a deposit-taking institution, so we can't hold that money, which is a major challenge for us. We hold it in their name or the name of their group in a deposit-taking third-party bank, and then that money is returned at the end of their typically about 6-month loan cycle. Today we have $100 million in loans, as I said. It's more than that now at the end of the first quarter, but we have about $20 million in client savings. So that's a fairly large amount of money, particularly when you consider that the money is returned at the end of the cycle, so it would often then be used for some consumption or investment that would replace loans. We've experimented with various kinds of savings schemes. We're not regulated, so we can't take deposits. We've used the internal, the thing that you described for Oxfam is, it's a savings scheme, but it's also a self-funded credit scheme, right, in which the clients can lend each other money. We have experimented with that. We've had many difficulties with it and eventually abandoned that. What is called an internal account or a tanda, very traditional ways of savings in many cultures, as you mentioned. We found many problems with that we felt institutionally weakened our institution and were very problematic for our clients as a group. They are essentially taking risk on each other, client risk on each other, and that's hard to control. They try to control it, but in a village system, you have opportunities for conflict, for coercion, many other elements that we felt weren't consistent with our mission, so we don't do that anymore. We do this more traditional angle. It is an institutional goal of ours to develop more robust savings products. We agree completely that clients need a whole suite of financial services. and other services. Currently, we also provide insurance, sell insurance. We are a conduit for selling insurance to our clients, life insurance. We like to develop more insurance products for our clients. And, you know, people at the bottom of the pyramid have many different financial needs, and credit is only one of them. We view credit as an important thing because most people at the bottom of this spectrum either have no means to employment other than what they themselves do every day. There is no opportunity to have what we would call a job. Any of us in this room would call a job. And they also have very inconsistent and irregular flows of income. So it's very hard for them to accumulate money to invest in creating a stream of income or achieving a life goal like better education. And you can ramp that up more quickly if you can make that funds available to them right out the box. But savings, our clients love savings. When we survey them and we say, what do you like about Pro Mujer, even though our savings accounts are cumbersome and pay them very little money, it usually ranks at the very top of what they like about our services because they really lack the means to save on a regular basis in a safe place. And just as many studies have shown with loans, interestingly, the rate of return or the rate of cost of the loan is actually less important if you ask them what they want than the accessibility. So simply the ability to save from, you know, your husband's incursions on your savings or your cousin who wants, you know, your money to take care of their own problem is highly valued by clients. So we have an institutional goal of creating more and better savings systems. The system we have right now is very problematic in that it doesn't pay them very much interest. And the banks we hold their savings in, as you know, just to enumerate some of the problems that poor people have with savings, don't like the small accounts. They don't like lots of poor women, about 95% of our clients are women, standing around in their institution trying to get service. That's not generally good for the rest of their business. It's part of the exclusion and prejudice that poor people face in their own countries when they try to get services. So we would love to be able to offer better savings products directly where they had better access, better returns, a more respectful treatment. The problem institutionally, there are many problems. First of all, you have to be regulated and able to take savings as an institution. Informal groups like the ones described obviously don't face that hurdle. The second thing is that it's just a fundamentally different business. When you're offering to loan people money, there are lots of takers for that service. When you want to take people's money and husband it for them and potentially use it in your own operations, which we don't now, but deposit-taking institutions do, you have a whole set of obligations and expectations that are very, very different than credit. And one of the most important obligations is that their money has to really be safe and have to be able to return it whenever they want it. So the liquidity management issues around offering a savings product as an institution are really large, and you have to have a very sophisticated, very rigorous internal system of controls and cash management to do that on a reliable basis, to be utterly and completely safe to your client, and be able to meet their demands anytime they want. That's for a cash account. But even for demand accounts over time, you still have to manage people's expectations and your obligations to them. At this very moment in time, we don't feel we have the level of infrastructure we need in our institution to make us comfortable that we can make good on those obligations. But we're building that over time. The second is the design of products. There are many ways in which people can design, savings products. The committed product that I think you talked about is like what our grandparents used to call it. Christmas savings account or Christmas club where you put $10 in every week and then you have it at Christmas to spend on money. We now have credit cards in the U.S. so nobody borrows money. They just borrow the money. Cash accounts, accounts that are immediately available, longer term savings accounts. All of you have to design those products with your client in mind, who again is a person living at the edge of poverty, subject to a lot of shocks, and unforeseen needs. So there's a whole design aspect to products and the suite of products you offer. And probably the third most important barrier is cost. The $70 per account dropping to $25 is a great example. That's actually a lot of money. If you think about 250,000 clients and $20 million in savings, that's less than, can you do the math? It's like $100 per client, something like that. And a lot of money. If you have to spend $25 to administer something, only $100 in value, you're losing money. And most people, when they institute savings, sort of regulated institutional savings programs, they are huge money losers in the beginning, which you just have to fund. And to be viable over time, from what we've seen, they cannot focus just on the clientele that you're serving, because that clientele is always going to have very small balances under traditional methods relative to the cost of maintaining them. So you really have to build a savings system that anticipates funding or providing the savings mechanisms to your small client, and then also having a whole array of other people who are not your target clientele who save with you in amounts and in a character that basically subsidizes the rest of the system. Institutionalized sort of traditional savings system. There are a lot of promising developments with respect to mobile technology and things like that that could bring those costs way down, and have in certain countries. The availability and applicability of those is very dependent on your regulatory system. In Latin America, at least, in the countries in which we operate, the banking authorities have not been very supportive of those mobile banking systems and really have focused most of the enabling legislation and mechanisms on things we would think of as pretty traditional savings accounts. Not, physical buildings, accounts in which you have to have a lot of very traditional infrastructure around savings. So at least at this very moment in time, in the jurisdictions in which we operate, those lower cost mobile banking systems are not largely available. So we're sort of confronting, as we think about savings, and we're sort of in planning stages for those, whether rather than provide the mechanisms for ourselves, for example, we could partner with other institutions and use their infrastructure, or other ways we can bring that cost way down, or be agents, if you will, as opposed to principals, but in a more effective way in order to lower costs. So it's a pretty complicated equation. Infrastructure, liquidity managed, cost, product development are the biggest obstacles to implementing a really self-sustaining savings product that is attractive and competitive for your clients, and one that is sustainable over the long term. But we are focused on doing that, principally as a means of serving our mission, because we'd like to increase the number of financial products our clients can take advantage of. Right now, as they build an income stream, they do save if their family consumption goes up. One of the most important ways of saving is that perhaps their children don't have to work, for example, and then can stay in school. That's essentially an investment they're making by being able to displace the income those children would produce with the income they can produce in their business. But we'd like to facilitate savings in more traditional ways that are more accessible and liquid for our clients. I think I'll stop there because it's about 8 o'clock. And then we'll do questions.